Today the market fell, and you checked your portfolio 17 times. What did that cost you? Not just the time, not just the distraction. What it cost you was the decision you didn't make. The buy order you hesitated on. The stock you sold because you looked at it one time too many and convinced yourself the red numbers meant something they didn't. Every glance at your portfolio when markets are calm isn't information gathering. It's emotional rehearsal for panic. You're training yourself to react. And in the 30 seconds it took you to check your phone just now, you reinforced a pattern that will cost you tens of thousands of dollars over the next decade. Seneca wrote that we suffer more in imagination than in reality. But here's what he understood that you don't yet. The suffering isn't the problem. The decisions you make while suffering are. The VIX closed today at 17.16. For those who don't obsess over market internals, the VIX measures fear. Specifically, it measures how much investors are willing to pay to protect themselves against market chaos. Below 15, the market is dangerously complacent. Everyone's comfortable. Nobody's preparing. Above 30, panic has set in. People are making decisions to stop pain, not to build wealth. 17.16 means we're in the calm zone. Not euphoric. Not terrified. Just calm. And calm is exactly when you lose the most money. Not because the market punishes you in calm, because you don't prepare during calm. You check. You monitor. You refresh. You tell yourself you're staying informed. What you're actually doing is staying emotionally engaged with every minor fluctuation. So when the storm actually comes, you have no emotional reserves left. You've spent them all on days that didn't matter. Seneca had a practice called Praemeditatio Malorum, premeditation of evils. Before a journey, he would imagine shipwrecks. Before a friendship, betrayal. Before investing his wealth, total loss. Not because he was pessimistic, because he refused to let future pain catch him unprepared. He wrote, "The unexpected blow lands heaviest." So he removed the unexpected. He didn't avoid risk. He pre-experienced it, emotionally rehearsed it, decided in advance how he would respond. And when the actual storm came, he had already survived it once in his mind. The market didn't shock him. It confirmed what he'd already prepared for. That's the 17.16 rule. When the VIX is calm, when your portfolio is boring, when nothing dramatic is happening, that is when the Stoic investor does the only work that actually matters. They prepare, not by checking prices, by checking themselves. Let me show you what this looks like when someone gets it wrong, then gets it right. March 2025. Markets had been climbing for 11 straight months. The VIX was hovering around 14. Alex Chen had a portfolio worth $470,000. The result of 15 years of disciplined saving and decent returns. He checked it every morning with coffee, every afternoon between meetings, every evening before bed. On good days, this felt like diligence. On boring days, it felt like control. He told himself he was staying informed. What he was actually doing was building a habit of emotional reaction. Green numbers felt like validation. Red numbers felt like warnings. He never noticed he was teaching his nervous system to treat portfolio fluctuations like threats. Then July arrived. The market dropped 3% in 2 days. Nothing catastrophic. VIX jumped to 21. Not panic territory, just elevated concern. Alex checked his portfolio 43 times in 48 hours. He knew the number because his screen time report told him. Each time he looked, his account was down another few thousand. 22,000 totaled by midweek. And each time he looked, his brain screamed at him to do something, not because something rational needed doing. Because he'd trained himself for months to believe that looking meant acting. Information meant decision. He sold 30% of his holdings on Wednesday afternoon, raised cash, told himself he was being prudent, Protecting capital. Waiting for clarity. Marcus Sterling, on the other hand, didn't check his portfolio once that week. Not because he didn't care, because he'd already decided. 6 months earlier, when the VIX was at 13 and markets were boring and nothing was happening, Marcus spent an afternoon with his leather journal and wrote down 3 scenarios. Market correction of 10%, bear market of 30%, crash of 50% or more. For each scenario, he wrote what he would feel: fear, regret, panic, urge to sell, urge to check the news constantly. He didn't write what the market might do. He wrote what his emotions would try to make him do. Then he wrote his response. For a 10% correction, do nothing. Check. Portfolio once per week maximum. Continue automatic investments. For a 30% bear market, reduce portfolio checks to once per month. Increase equity purchases if cash available. Reread this journal entry daily. For a 50% crash, assume total loss emotionally. Check portfolio once per quarter. Call this the opportunity of the decade. When July's 3% drop happened, Marcus felt the same spike of adrenaline Alex felt. Same urge to check. Same little voice suggesting maybe this time was different. But he didn't need to decide in that moment. He'd already decided in March, when his emotions were calm. He opened his journal, read what he'd written. 3% isn't 10%. This isn't even category 1. His instructions were clear. Do nothing. He closed his laptop, went for a walk. When Alex was refreshing his brokerage app for the 20th time, Marcus was reading a book that had nothing to do with markets. Not because he was disciplined in the moment, because he'd made discipline automatic 6 months earlier. By August, markets had recovered. Alex's portfolio was worth $435,000. He'd sold at the bottom of a minor dip, missed the recovery, and was now holding cash, waiting for the right time to get back in. Marcus's portfolio was worth $492,000. Same market, same volatility. $57,000 difference. Not because Marcus was smarter about markets, because he was smarter about himself. He prepared in calm for decisions he'd have to make in chaos. Alex reacted in chaos to situations he never prepared for in calm. That's the 17.16 rule. The VIX is calm today, which means most investors are doing exactly what Alex did in March, checking constantly, staying engaged, mistaking activity for preparation. When the next drop comes, and it will come, they'll be exhausted before the storm even starts. Their emotional reserves will be spent on 1,000 meaningless checks during 1,000 boring days. The Stoic investor does something different today. Right now, while nothing is happening, take out a piece of paper, write 1 sentence. I will check my portfolio once per week, Sunday evening, regardless of what markets do. Sign it. Date it. Put it where you'll see it tomorrow morning. Not because checking less gives you better information, because checking less gives you better decisions. Seneca wrote, "Nothing is ours except time." Every time you check your portfolio during market hours, you're spending time to increase anxiety and rehearse panic. You think you're gathering data. You're actually training yourself to fail when it matters. The VIX is 17.16 right now. Calm, which means you have time to prepare, or you have time to check your portfolio again and pretend that's the same thing. One of those builds wealth. The other just burns time while convincing you you're doing something. Most investors won't understand this until they lost money they didn't need to lose. You don't have to be most investors. Your emotions are costing you more than any market crash ever will. Next video proves it.